Section 5.1 Understanding Dividend Payout Ratio, Key Considerations for Dividend-Focused Investing. 5.1 Dividend Reinvestment. Dividend reinvestment plans, DRIPs, offer investors the option to automatically reinvest their cash dividends into additional shares of the company's stock. While DRIPs can have certain advantages, they also come with a few disadvantages. Here's an overview of the pros and cons of dividend reinvestment plans. Advantages of DRIPs: compounding returns. DRIPs allow investors to benefit from the power of compounding returns. By reinvesting dividends, additional shares are acquired, which can generate more dividends in the future. Over time, this compounding effect can enhance overall investment returns. Cost efficiency. DRIPs often offer the opportunity to reinvest dividends without incurring transaction costs or brokerage fees. This can be advantageous for investors who want to reinvest small dividend amounts on a regular basis, as it eliminates the need to pay fees for each reinvestment transaction. Automatic and convenient. DRIPs provide a convenient way to reinvest dividends automatically. Once set up, investors don't need to actively manage the reinvestment process. The dividends are automatically reinvested, making it a hassle-free option for long-term investors. Dollar cost averaging. Through DRIPs, investors can employ a dollar cost averaging strategy. By regularly reinvesting dividends, investors purchase additional shares at different prices over time. This approach can help mitigate the impact of market volatility, as more shares are acquired when prices are low and fewer shares when prices are high. Disadvantages of DRIPs: lack of flexibility. DRIPs typically reinvest dividends only in the company's stock, limiting diversification options. Investors may miss out on opportunities to allocate their funds across different securities or sectors. Exposure to single stock risk. DRIPs concentrate investments in a single stock, which increases exposure to the performance and risks associated with that particular company. If the company faces financial difficulties or experiences a decline in stock price, the impact on the investment portfolio can be significant. Tax implications. DRIPs can create tax complexities for investors. Even though dividends are reinvested rather than received as cash, they are still considered taxable income. Investors need to keep track of the cost basis of the reinvested shares for future tax calculations. Limited control over timing. With DRIPs, investors have limited control over the timing of the reinvestment. The reinvestment typically occurs on predetermined dates, which may not align with an investor's specific investment strategy or market timing preferences. Lack of cash flow. Reinvesting dividends through DRIPs means foregoing the opportunity to receive cash payments. This can be a disadvantage for investors who rely on dividend income to cover living expenses or for those who prefer to have the flexibility to allocate the cash elsewhere. Ultimately, the decision to participate in a DRIP depends on an investor's individual goals, preferences, and investment strategy. Investors seeking long-term growth, compounding returns, and cost efficiency may find DRIPs advantageous. However, those who prioritize diversification, flexibility, or prefer to have cash flow from dividends may find alternative investment approaches more suitable. It's essential for investors to carefully consider the advantages and disadvantages of DRIPs and assess their compatibility with their specific investment objectives and circumstances. Dividend reinvestment can have a significant impact on portfolio growth and compounding returns over the long term. Here's how dividend reinvestment can enhance portfolio growth. Increased share ownership. By reinvesting dividends, investors acquire additional shares of the company's stock. Over time, the number of shares in the portfolio grows, increasing the overall ownership stake in the company. This expanded ownership can result in higher capital appreciation potential if the stock price appreciates. Compounding returns. Dividend reinvestment allows investors to benefit from the compounding effect. As dividends are reinvested and additional shares are acquired, those shares are then entitled to receive future dividends. This creates a compounding effect, where dividends generate more dividends, leading to exponential growth over time. Compounding returns can significantly enhance portfolio growth, especially when reinvested over long periods. Dollar cost averaging. dividend reinvestment facilitates a dollar-cost averaging strategy. By reinvesting dividends regularly, investors automatically purchase more shares at different prices over time. This approach can help smooth out the impact of market volatility. When prices are lower, more shares are purchased, and when prices are higher, fewer shares are acquired. This disciplined approach can reduce the risk of making large investments at unfavorable prices and potentially improve long-term returns. Long-term capital appreciation. Dividend reinvestment can lead to long-term capital appreciation. Companies that consistently pay and grow their dividends tend to be financially strong and have solid growth prospects. Reinvesting dividends allows investors to participate in the company's growth by acquiring additional shares. Over time, as the company's earnings and stock price increase, the value of the reinvested shares can grow, contributing to portfolio growth. It's important to note that the impact of dividend reinvestment on portfolio growth depends on several factors, including the dividend yield, the rate of dividend growth, the stock's performance, and the length of the investment horizon. Higher dividend yields and faster dividend growth rates can accelerate portfolio growth. Additionally, the longer the dividends are reinvested, the more pronounced the compounding effect becomes. To assess the potential impact of dividend reinvestment on portfolio growth, investors can utilize financial models or online calculators that simulate the growth of investments with and without dividend reinvestment. These tools allow investors to compare the hypothetical outcomes and visualize the benefits of reinvesting dividends over time. However, it's important to remember that investing involves risks, and past performance is not indicative of future results. Investors should conduct thorough research and analysis. Consider their risk tolerance, and diversify their portfolios to mitigate risk. Dividend reinvestment is just one element of an overall investment strategy, and it should align with an investor's long-term goals and risk profile.